Welcome into Phil's Tax Hacks and Other Retirement Facts with CPA and personal financial specialist Phil Putney. Now let's get rolling with today's show. Hey gang, welcome into another edition of Phil's Tax Hacks and Other Retirement Facts. I'm going to ask you not to click off the video or the podcast when I say the word insurance.
That's right. Life insurance, everyone's favorite topic.
Oh man, it's so boring. But we got actually some good stuff I want to talk about this week because it's a really powerful tool and it's changed so much.
It absolutely is. Yeah. And you're right. I mean, it's not the life insurance of old, so to speak.
It's
not your daddy's life insurance.
That's right. So I've got a couple places a little bit different from the norm. I'll do a couple of norms as well, but that I wanted you to highlight where it could be useful that people might not think of it as a tool for that. So these are some reasons that you should consider getting life insurance. So let's jump in. Income replacement, Phil, that's the main thing we think of when we're 40 and we think I've got to have insurance in case I die in an accident so that the kids are taken care of in the house and all that stuff. But as a retiree, and that's our demographic here for the podcast, you could still do income replacement, maybe for a pension lost or Social Security.
Yes.
Yeah.
Yeah. And I mean, that is probably one of the biggest misconception of life insurance when you get into retirement is, I'm retired. I've already saved what I need to, so why do I need life insurance anymore? I'm not working. There is no income replacement.
Right.
And you're right. I mean, from a job, you're correct. There's not that need for income replacement because you're retired. But there's a lot of things that happen to a surviving spouse. Loss of income from a pension depends on the pension election you made. So if you didn't take 100% survivor option, and there's a pension involved, that spouse is going to lose all of it. If you took the single life, up to maybe 35, 50% of it kind of depends on whatever the option is you elected. There's going to be a loss there.
And there's a lot of pensions still here in the Motor City area.
In our area, pensions are still pretty prevalent, so you've got to be careful and understand what is that pension election that was made.
Yep.
The other one is Social Security. And that's a very significant part of the overall equation because in a surviving spouse scenario, there is survivor benefits, but all that simply means is that out of that married couple, the highest benefit survives.
Yeah, you don't get both, which we all know.
You don't get both, right? So, but also what that means then is that married couple, the lowest benefit's gone. So there's always a loss of income.
I mean, let's say one's doing $3,000 a month, the other's getting $2,000. You keep the $3,000, you lose. I mean, $2,000 a month is substantial to your way of life.
Yeah. And I mean, if you're both at similar earnings or have been, I mean, it could be a 50% cut in income. So if there's not spousal or some other scenarios built into your plan.
Yep.
So just again, don't make the assumption, like a lot of different assumptions that are made in retirement. Oh, I don't need that because I'm retired. Run the math, look at it and see. And the other one, again, putting on that tax hat is a surviving spouse is now single. So before you were married filing joint, what that means is all the tax brackets get compressed. So you get pushed into a much higher bracket quicker, which we see it all the time when we're running the math and I mean, actually experiencing it, unfortunately, where we have had clients that early in retirement lose a spouse and they get pushed into a significantly higher bracket if you've not done some planning ahead of time to help position assets the right way. So you have to, it's what we call a stress test on the plan. We're always stress testing at the end to say, okay, if you live full life expectancies, it works great. But what happens if Mr. or Mrs. client, you pass away today?
Yeah, exactly.
Where does that leave your spouse? What does that look like? Let's run the math and see.
Let's go to estate liquidity, Phil, for the second one. Using it to maybe there's a big estate, maybe there's a tax load. Number a little bit more common use, I suppose. Yeah,
I mean, back in the day, it was more common before the estate thresholds were so high.
And they could be coming back down, or did.
And I mean, if they haven't yet, but they could be coming back down. I would not be surprised. They've talked about it. It's been kind of on the roadmap. But yeah, that used to be a very significant problem if your primary investment was real estate. So if you were in rental properties and you had all these rental properties and now you passed away, and there was an estate tax due, and the IRS doesn't wait for their money. They want their money on time. Otherwise, you're paying a penalty and interest.
They're not sorry that you passed away and they want to give you a bereavement period.
Right. And they don't accept houses as payment. So they want cash. So,
that could change.
It could change. It could change. They might be taking a crypto sometime, but that's a whole other discussion.
Well, we'll save that for another day. But anyway, so.
But yeah, so anyways, Yeah, it was a means of creating liquidity that
Yeah.
you wouldn't have to all of a sudden sell a bunch of the real estate at a bargain sale just to try to generate cash to pay an
To
estate
cover the
tax.
taxes, yeah.
Yep.
I'm going to skip 3 and jump to 4 because it's kind of in that
Sure.
same vein with the family. I want to stay
Mhm.
there. Transferring family wealth. We've talked many times about the
Yep.
removal of the stretch IRA, different little things that are happening to kind of make generational wealth a little bit more challenging.
Mhm.
Life insurance is clearly one way that you could do that and still kind of build that family wealth if you wanted to.
Absolutely. I mean, and if that is one of your goals is leaving X amount to the kids or grandkids, even, life insurance is a great tool for that
It's still
because
pretty tops tool for that, right?
yeah, absolutely. Well, because you get number one, you get leverage, right? So you're putting in a small premium compared to what the death benefit is.
Mhm.
So there's significant leverage, especially if something happens early,
Right.
you know. But even if it doesn't, if it's later on in the plan, you still have usually pretty significant leverage. And number two, it's all tax free. So a death benefit is not taxable. So yeah, if that is one of your goals of, I specifically want to leave X amount to the kids or grandkids or whoever it is, don't brush over life insurance. I mean, it can be a very, very useful tool because if you want to leave $100,000, I mean, it's very easy now to price that into your plan to say, okay, what it's going to cost me to do that is X amount a year in my plan. Done. You don't have to worry about, well, I need to put this account on the side and that's kind of where I'm saving it for. It's you just build it into a budget from a premium standpoint and you get a very defined benefit at a very defined cost. So
yeah, I mean, and leaving it tax efficient to your heirs, I mean, it's just a win-win. So, and I like that you said don't brush past it, because one of the things with insurance, much like annuities, and we've covered that before, on people sometimes will walk into a financial professional's office and say, "Don't talk to me about X, Y, or Z.
I don't like this. I don't like
you
that."
ever said, yeah, and that's the worst attitude because you may not need this. Insurance may not be for you, but why take the hammer out of the toolbox before you ever start the job? Because if you're like me, end up having to hammer something and you got to use the back end of a crescent wrench to try to hammer something. And that's the worst.
It might work, but it's not going to look pretty.
But it's not good. Right? So get the right tool for the job. So I'm glad you said that, because you just don't want to eliminate something off the top. Right. I like this next one too, Phil. This one's one maybe people don't think about. Business succession, using life insurance for that. So you and I are we're not, but let's just say you and I are business partners. You pass away and, your wife wants to be bought out. She doesn't want to continue on. I might need to have insurance or use the insurance that we may have had in order to do that, right?
Correct. Yeah. So succession planning in a business, it's vital. Because number one, you as the surviving business owner probably don't have the cash to buy that spouse out.
Right.
So you might now be forced to be in business with the spouse or the kids. And that's probably not a scenario or a relationship you want. So having not only the life insurance, but first of all, the plan in place. So having a succession plan and a buy-sell agreement in place that says this is what's going to happen, this is how much the price is. And now it's structured and funded through life insurance. Now it can be actually completed. So,
yep. Great tool. Again,
for business owners, it is critical. I would not be in business. Yeah, I wouldn't be in business with somebody without a buy-sell agreement that's funded through life insurance, because you never know. I mean, life happens.
Yeah, that's right. Yeah. I've said many times, I don't know who this Murphy guy is and him and his laws, but we should find him and give him a what for. Yeah. I mean, it's a great tool. There's so many independent small business owners in the country. Obviously, that's a huge backbone. So certainly something worth talking about that with your financial professional. All right, let's go to, I'd be remiss, Phil, if I didn't bring it up, because there's so many ads and promotions and whatever, where you hear people saying get a tax-free retirement, like especially if you're an insurance only salesman or insurance only financial professional, then that's the only tool you have to work with. And so there's a lot of conversation about you can use it to get a tax-free retirement. What's the skinny on that?
Yeah. So, I mean, that is one of the, I don't want to say the byproducts of life insurance, but just how they work. And it's not term insurance. So what we're talking about here is something that builds cash value.
Okay.
So a whole life policy could be variable index universal life, a lot of different versions of it, but it's something that has a cash value. And the reason this works is that under the IRS code, the growth of that cash value inside the life insurance policy grows tax deferred. It can come out tax free in certain instances.
Okay,
You
and
can,
certain
first of
instances.
all, you've got to be very careful on how you structure that. So if you're taking your premium back as a distribution, and that's the first money out, that's always tax free. But if you take beyond that and get into the growth, then that could be taxable.
Right. Makes sense.
How typically it's structured to make it tax free is, and this is kind of convoluted, and don't tune out when we
We
talk
won't go
about
too
this,
far in
but
the weeds, but
yeah,
yeah.
they bottom line is you're basically borrowing from the life insurance company, typically at a fixed rate.
Okay.
And then that life insurance company is using the death benefit as collateral, or the value, the cash value, and ultimately
I
the death
got you.
benefit as collateral, because they know statistically you're going to pass away at some point. So if you think this through, when you borrow, that borrowing is tax free. If you take money from a mortgage
Okay.
and
Yeah.
put it in the
Yeah.
bank to buy a car or whatever, that's tax free. That money that came out in a loan. So the borrowing is tax free. And then ultimately, when you pass away, the life insurance, the death benefit now pays back that loan.
Mhm.
So that's a tax free act as well. So that's how we get tax free income out of life insurance. I mean, it works. It's something to again, don't brush over.
Yeah.
But be very careful, because there's a lot of, to your point in the
Sticky point.
beginning, yes, there's a lot of selling, so to speak, around this, that it can be a great tool for diversification is the way I look at it.
Okay.
We have a
And
lot
it
of
can also
clients that
be a
will,
tool for high income earners too, right? If you're
yes.
priced out of like a Roth.
Yep. Yeah. So it's another way of generating tax-free income. So that's what I was saying with diversification of types of income.
Yeah.
In tax-free types of income, there's not many options. A Roth is the primary one.
Right.
Well,
Yeah.
this is another way of getting some diversification,
Okay.
is having maybe a cash value life insurance policy that's going to be able to generate that kind of income in the future. The whole key with these is you have to overfund them, meaning you got to put in the maximum amount of premium that the IRS says you can, or typically they're just not going to work.
Gotcha.
So you got to really understand the tool, how it works, and don't be afraid to commit to it, provided it fits in your plan, and actually commit to it. Where I see these fail all the time is, all of a sudden somebody will start and then they realize, I got to put how much away for how many years? I'm not going to do that anymore. And then it falls apart. So,
okay. So definitely don't take it lightly. Make sure that
no.
you're having, the conversation with your advisor on whether it's any of these things, right? Any of the stuff that we
Right.
kind of covered, they all have some great uses, but it's just a matter of making sure that you've drawn it up the right way. And we'll
Yep.
finish it off, I guess, Phil, with a pretty easy one as far as we're thinking about anyway, insurance, and that's just using it for long-term care coverage. Obviously, that's probably the main thing a lot of people are thinking about now, but it's gotten
Yep.
so pricey. What do we do here? A lot of times we think about like, well, you mentioned like the death benefit, you hear things like the accelerated death benefit. You hear things like if you have insurance and you can't perform so many daily activities, there's all these different like caveats and stuff.
Right.
So it gets
Yeah.
a little
There's a lot of ways life insurance can be used in helping with the long-term care avenue. I mean, one of them is just to replenish maybe assets that were spent to provide long-term care. So if, because of long-term care, you spent down a lot of your assets and now your surviving spouse still needs income. Well, life insurance pays, and now there's an extra asset now that can help provide the rest of the income.
Yeah.
Or to your point, I mean, there are actual policies that are designed as a long-term care vehicle. It's life insurance, but it's got a long-term care benefit.
right.
Or it could be what they call chronic illness, which isn't technically long-term care. It's just an acceleration of that death benefit. But again, it's and this is really where it gets into more. It's not the life insurance of old. I mean, this is I'm going to say relatively new feature. And if we're insuring for long-term care, typically this is the avenue we're going to approach, because it takes away one of the biggest fears or risks in covering long-term care, which is, well, what happens if I never need it? Right. So if you paid into this long-term care life insurance or long-term care policy for years and never need it, well, you lost all that money.
Gotcha.
If it's structured in a life insurance type of vehicle, well, now at least there's a death benefit, so somebody's going to get some benefit back. Sometimes it can be structured in such a way that it's about the amount of premium that you paid in. So,
Okay. And Phil, talking about insurance here, we'll wrap it up with this. In what you do, you're a CPA, you're a personal financial specialist. You've got the gamut. It's not something that you need. We were talking about salesy earlier, being pushy on whatever the case is. We tend to think of Ned Ryerson was the character in Groundhog Day.
Yep.
Yeah, the guy comes up and he's bugging Bill Murray every day.
Yep. Every day to buy life insurance. Yeah.
Yeah. And we tend to think of that kind of character, with his big trench coat on, and he's constantly pushing. But it's a tool that you have that you can use, if you see the need to fill it with that particular product. But it's not something that, again, it's all about the person you're working with, and do they have all the tools available to help you with what you need versus just saying this is the thing for you and trying to hit you over the head with it.
Right. Yeah. I mean, if life insurance is the lead, right? If that's the thing they're always approaching you with, be careful, because why is it there? Does it really fit into your plan?
Right.
Versus like how we'll use it. We're running a plan, not talking products at all. First, let's just run the math and make sure everything works. Let's stress test it. Now we know, is there a need for it?
Yeah.
Number one, if there's a need, well, then let's get a product that works. And a win-win, and we see this very often, is where there's a scenario that there's actually a need for life insurance. And if we now fill that need by using cash value life insurance, we can build an asset that becomes tax-free later on, so that we cover both sides of the equation. So if the spouse passes away early, well, we've actually covered that need. Because if we're building life insurance for the tax-free income side of it, well, then the death benefit is just a byproduct. It's the byproduct of it being life insurance. But if you needed the life insurance, that's a win-win, because now we're using this byproduct of a tax-free income to actually cover a death benefit need that you had. So,
well, and that's why I say we're all puzzles when we come in and we're sitting down as a potential client with someone like yourself. You're kind of going through and you're building the puzzle, the math problem. And you're saying, okay, I've got most of this figured out, but I've got a couple of gaps here, and these are some of the options we have to fill those gaps. So it's just it's just another tool, and so we won't go any longer on that. That way, since it's life insurance, people are like, okay, I'm not going to spend that much.
They're already
time
starting to tune out.
That's right. So there's a lot of options, but think about the main bullet points, at least, folks, as some ideas that you might need within your particular life, as why it could be a good fit for you. And then definitely talk with a qualified professional before you take any action, of course. And like Phil said, if they're leading with something, anything really, and that's the constant go back versus building a plan and kind of solving the math problems, then maybe it's not the right fit for you. So stop by the website, philstaxhacks.com. That's philstaxhacks.com. Schedule some time, talk with him, subscribe to the podcast on whatever platform you want. You can redirect back to his main website for that scheduling. You can call him at 248-888-7530. It's all on the screen if you're watching, all that good stuff. So just always check with a qualified professional. Phil's been doing this. He's a CPA and a personal financial specialist for a long time, helping people.
Long time.
Great resource for you to tap into. Phil, thanks for hanging out and talking insurance.
Thanks, Mark.
Buddy. I appreciate you.
You too.
We'll catch you next time right here on the program. This has been Phil's Tax Hacks and Other Retirement Facts.
Investment advisory services offered through AFS Wealth Management. The content of this program is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. Investments and/or investment strategies involve risk, including the possible loss of principal. There is no assurance that any investment strategy will achieve its objectives.